So welcome to part two of tonight's program of the Opportunity Zones Meetup. In part two, we're going to shift our focus to the theme of tonight's program, which is raising money. And we're going to be very specific in this. Last program, we talked about setting up an Opportunity Zone Fund, and we went through a lot of the mechanics and rules, practical aspects of what you got to do to set up a fund so that it can properly receive money and then turn around and deploy that money into a qualified Opportunity Zone business or an Opportunity Zone property. Tonight we're going to focus on how that fund or the business who wants to get money into itself as a qualified Opportunity Zone property or business may raise money. And we're going to talk about, again, some of the practical elements of that. One of the things this meetup group does that I have not been able to find anywhere else is we get into the weeds. We try to figure out where the problems and challenges are. We don't worry about admitting that we don't know everything we would like to know because we think this is the quickest way we can learn and share information. So in this part of tonight's program, we're going to talk about first Opportunity Zone sources of funding. So to start off with, the Opportunity Zone legislation created a number of incentives for people who have capital gains from the sale of an asset to roll those capital gains over into a new investment that happens to be located in geographic areas that have been specified by each state and approved by the IRS. If that investment is made and the investment is held correctly and all the other rules and so forth that we've been talking about apply, there are three types of gains. One is the person gets an immediate deferral of their capital gains tax that they otherwise would have had to pay in the current tax year. So what we're seeing here is somebody can bump down the road the liability, the taxes that they would have to pay for capital gains by putting that money, rolling it over into an Opportunity Zone investment. The second benefit is a reduction of those taxes. So if you put it into an investment, qualified investment, and you hold it for 5 years, the basis or value is boosted 10 points, which means in simple terms, if you owed $100,000 in taxes, you now would only owe $90,000 in taxes. So you get an automatic decrease in your tax liability by holding it for 5 years. If you hold it for a total of 7 years, you get another 5% or 15% in total. So again, if you owed $100,000 in taxes, that would be decreased by $15,000 or 15% over what you would have owed otherwise. So there is a benefit for holding for a period of time of 5 or 7 years, and this directly impacts why people are now talking about how soon they have to get an Opportunity Zone project funded, because in order to get to the 7-year maximum benefit from Opportunity Zones, this has to be funded by the end of this year, 2019, or the clock will run out. You still have 2 years till 2021 in order to get the 10% benefit. So a lot of people are saying, yeah, 5% is good. In large quantities, 5% is a lot of money, but in small quantities, it's not really that material important to me, and I still got 2 more years to get something together. Then the big benefit, and some people say the only real meaningful benefit of the Opportunity Zones tax incentives is if you make an investment and leave it in there for 10 years, any gain or profit that you make, and I'm going to qualify that, any capital gain that you make on that investment is tax-free. And therefore, if you put money into a high-flying tech company, it goes up 10x in value. All that 10x appreciation is tax-free. If you put it into a real estate project and you double your money or maybe triple your money over the 10 years, that appreciation is tax-free. So the big incentive is to put the money to work in a distressed economic community and let that money work hard for a 10-year period of time. And if you leave it there for that period of time, then you will get the maximum tax benefits that are available under this statute. So this is what we're looking at. And because this is a tax incentive, as you might suspect, the primary reason why people might invest in an Opportunity Zone is to gain this tax incentive. we're talking about making an investment. This investment is really no different from any other investment in terms of quality of the deal, risk associated with the deal, all the different things that go along with the deal. And the tax incentive has no impact on the quality of the deal. So if you're coming at this from an investment standpoint, first you have to look at the quality of the deal. And if you don't like it, you don't do it. If you like the deal, then if it's in an opportunity zone, you have a chance to get a higher yield or a higher payback by all these incentives. One of the problems that has occurring already, and so I bring this up in a lot of the programs that I do on raising capital, is what's called the streetlight effect. If you're not familiar with this, this is an old joke where this guy is on the street and he says, "I dropped a quarter." The cop says, "Did you drop it here?" And he says, "No, I dropped it 2 blocks down the street over there." And so the cop says, "Well, why are you looking for the quarter here?" He says, "Well, because there's a street light here, I can see better." And in raising money, all too often, people look to large financial institutions who are holding a lot of money, whose job is to deploy that money because they're easy to see, they're easy to target, and therefore they're thinking, well, that's where the money is, that's where I should go to get the money. But they're failing to take into consideration that they may never meet the criteria for that particular source of money, and it doesn't matter how much money they have or how much money you need, that is not going to result in a successful capital campaign. This is often done where people say, I'm going to go talk to a venture capitalist, I'm going to talk to a set of angels, a family fund, somebody, because they're visible and they know that they have funding. But at the end of the day, funding may not occur. One example of that is a project that was from the Western Slope. I was contacted by a property developer out there. He says, I want to put in a multi-purpose office building out here. And I talked to a number of people, and they're going like, no, we don't do the Western Slope. Nothing against the building, nothing against the project, nothing wrong with the mechanics of the model, but it's outside a geographic area for people who tend to invest in their own backyard. And this person is still hunting for someone who considers their backyard to include the Western Slope of Colorado. And that's a geographic thing. You'll see other people will break it out by industry where they say, I'll do hemp, but I won't do marijuana. I won't do hemp or marijuana. Maybe I'll do lettuce, but I've got something that I prefer. And that's all they're going to look at. And spending time talking to someone who's never going to fund you is a waste of time that you don't have if you're out raising money. So we talk about time being the critical most aspect in a fundraising campaign. You want to use your time efficiently and effectively to talk to people who have a reason to talk to you, who are inclined to give you money if you look like a viable investment candidate, and to move on. And so be careful of the streetlight effect, because there's a lot of people running around and saying, I want to talk to every opportunity zone fund that's out there, even though they won't qualify for maybe any of the opportunity zone funds that are currently in existence. So in raising money, there are 3, in my mind, this is my current perspective, 3 primary sources of funding. And because all these are in a position to take advantage of the opportunity zone legislation. So the first one are opportunity zone funds. These are, in some ways, seem obvious. You've created a fund. It's trying to take advantage of the opportunity zone laws and incentives. They have already raised money into the fund. So if a business or property is looking for money and they happen to meet the criteria of the fund, this is a done deal. This should be straightforward and very simple. And so, yes, you want to look out there and find out who the funds are, but before you go basically taking them out to coffee or buying them lunch or flying them to the Tahiti to try to influence them, you really need to ask the question, what are they going to invest in? And they're going to invest in your deal, your topic, your cause, or whatever it is you're doing. And if it doesn't match up, that's fine. They may still know someone who you should talk to. So making the relationship is good. And you may have another project. If you're moving through projects over time, you may come back to them later, because we have a lot of time left to do put projects together. The second one are financial institutions. These are things like venture capitalists, large banks, wealth management funds, insurance companies, where their business is managing money, either as a primary or secondary activity. They're still sitting on tons of money. And because they also typically have tons of capital gains. And if it's in best practices to move that money into an opportunity zone without changing the risk profile or hurting the yield on that investment, they should do that, and they will do that if they know about it. And they typically also have advisors who have been paid to scour the tax laws and know that opportunity zones exist as an incentive, and so they're going to be looking for deals. Now, they may not make the investment directly because they may be in an advisory role, or they may need approval of their client, but they will be looking, and they will typically be looking, though, in large chunks of money because they don't have time to get down into the weeds with small dollar investments. They're going to be talking typically in the $5, $10, or $50 million and up range. So you won't see them looking at smaller deals. On the opportunity zone funds, they can be all over the place. You could have a small fund, big fund, and we're seeing that people are breaking out kind of by dollar amounts, which is same as it is in the rest of the capital industry. $500,000, million, 5 million, 10 million, above 10 million, above 100 million. I know of a number of groups that have over $100 million to put at play, but they're usually going to spread it out over a number of deals. Commonly, a fund will spread it out over 10 deals on average. Some will do more, some will do less, because each deal requires the due diligence, the supervision, the oversight, and monitoring the deal through its life, and that puts more burden on the organization to do that. Then we get into wealthy individuals. Wealthy individuals are angels. But with capital gains, these are not limited to accredited investors. So you may find that a lot of people in a stock plan or retirement plan or somewhere else are picking up capital gains that they may decide that they are interested in redirecting into their community or into a project that they think makes sense, or somebody they know is leading a project that they're interested in. So these are all people, though, that have capital gains. They may range from very small to very large. They may be solo or in the aggregate very, very large. But they're your primary sources of funding. And it covers a large part of the population because almost anybody may have a capital gain from a stock investment. The big question, more important question, beyond who has the money is why would they make an investment, and why would they make an investment in you? So we start looking at the primary reasons, and the obvious one again is they're trying to make more money. They're going to make money on their investment. They want a reasonable investment. Some are high-risk flyers. Most people want a assurance that they're going to get their money back and a reasonable rate of return, and Opportunity Zones offers an opportunity for them to make a little more money on making an investment that they were going to make anyway. They may change who they're betting on between jockeys or horses, but they're still betting on a common type of activity that they're comfortable with. So people will do real estate, will not necessarily do oil and gas. Somebody may be environmental, certainly may not do oil and gas. Those kinds of things all come into play. Then we get into what I call community impact. This is what I mentioned earlier, is that we're expecting that communities who are in opportunity zones are going to get organized. They're going to pick 1 to 5 projects that they think are the key things for moving their community forward, kind of moving them from the back of the pack in a race to the front of the pack, and maybe even to a superior position. And one of the things we've been talking with a lot of communities about are concepts like the Innovation Hub as a private economic development driver that's working in public-private partnership with the communities, giving them a new industry or new industry focus that could help drive them. And so along this path, though, the communities quite often are not going to be able to offer a return on investment that you might see with a very nice, beautiful real estate project that's out near Denver International Airport. And so in that setting, you know, the community has to ask themselves, what can we do to make this deal more attractive. And we're going to get into deal terms when we're talking about this. But we may see something where the community does like a local fund that's not Opportunity Zone money and pair it or match it with Opportunity Zone fund money, giving more of the profits to the fund so that there's a more ROI, higher, more attractive to bring in that outside money. And then it's paired or matched with local money, who gets the secondary benefit from the investment in the community. The more jobs, more taxes, better schools, and things of that nature. The third part is strategic. And strategic means that somebody's investing their money, but the investment is a secondary concern to the strategic relationship with the person who's receiving the money. And this is commonly found in a lot of startups and businesses that I work with, where we'll find a supplier, someone in the supply chain, a reseller, who's thinking to themselves, if this company gets going and they're buying components from me, they're going to buy more components if they're successful. And I may make more money selling them components I'm ever going to make off my investment, but I have the money, and a little money here given to them as an investment gives me a twofer. I've got an ROI on the investment, and at the same time, I have a chance for a significant upside on my role or relationship with that particular company. And when people come to me and seek my advice on what can I do to raise money yesterday, I always start with who are your potential strategic partners, because they're already in the industry, they already know what the market is, they may have some cash, they may not, but if they will support you, that is a form of endorsement in you. It may give you the cash you need, and you're going to be working with them for a long period of time. So these are the three primary motivators that I look for. Sometimes you'll find them all in harmony with each other, and sometimes they will conflict with each other. But motivations are what drive the investment decision. And if you're trying to raise money, you need to find out what people are trying to do. If they're a money manager, their goal is to make more money. If they're doing an impact fund, then they're now looking at social causes, criteria, reasons why it would benefit a particular community or social cause or advance something that is benefiting society. And the strategic issue should always be there. And if you're raising money strategically, you will find that because the greater benefit is outside the investment, usually that money is going to be cheaper at a lower price to you than it would be if you're paying it to someone whose sole and primary purpose is to make more money, because that's what they're there for. And it's nothing against them. Everybody's doing their own job, but if you're looking at all your choices, you want to find somebody who cares enough to make a decision, has the money, and matches up with one of those three motivations. So as an example, I mentioned that I'm a principal in the Sugar Beet District project. We have set up a fund, meaning that we've legally established it, but we've not started our capital campaign yet. And the investors would be making money into the fund. The fund would in turn deploy that money into Net Zero Colorado as a public benefit corporation, which will be the active agent or money generator, if you want to call it from an economic standpoint. And over to the side, we have management services that are provided by NZ Development. And we have separated the management from the asset because the management company is going to do a series of projects, and we want to keep the asset management company as clean and simple to understand as possible. We're going to acquire property, we're going to improve it, we're going to put buildings on it, we're going to charge lease rental rates for a period of time, and somewhere in the future we can either liquidate this property and cash everybody out, or in our case we're talking about putting in a mandatory buyback so we can cash out the fund and we'll end up holding 100% of the project at the end of the 10-year time period. This project actually touches all the points. We've got real estate and we've got business and we have community elements to this. So we have lots of different people to talk to about this particular project in terms of who has money that may care and be motivated to help us move this particular project forward. And we're hopeful that as we complete the structure and lock it down, that it's going to be attractive to enough investors to raise our current target goal of $8.5 million. I say that because we're looking to do some land swaps, and some of those may either increase or decrease our capital requirements for this particular project. So in putting this together, this is something I recommend to anyone who's raising money, and that's create a stakeholder chart. And this chart, obviously, you can't read from the back of the room, but it will be in the slide deck. And don't worry about taking a picture. You'll get a copy of the slide deck as long as you registered for tonight's meeting. That's a warning to anybody who didn't register. But we'll get you a copy of the slide deck, and it'll also, we're going to put together what's called a guidebook or a handbook that goes along with this that will help provide more narrative and more explanation to the slides, because we don't have the time to get in that depth. But you go through who cares about the success of the project. In this case, the tenants are interested. So anyone we bring into this, and we're talking to grow facilities, we're talking about a hotel, 90-room hotel, a distillery, a brewery, some office space, some residential space, all those different vertical build-outs have an interest in this, because if we succeed, it's helping them succeed in their mission, their project. So we might see funding come from each of those, and we may yet find that we get all of our funding from strategic partners, and we're not going to strictly money managers. We have the contractors who can help build this out. The total build out on this may be in the neighborhood of $200 million. And that means the general contractors, the subcontractors, the engineers, architects, all those different people who we would ordinarily pay a fee to may decide they want to help us seed fund this project with capital gains, if they're holding capital gains, in order to put themselves in the exclusive position to be a contractor on this specific project. The landowners all stand to benefit. Right now, we're offering to pay cash, but we're actually working with them to do some land swaps that will result in them holding more property of greater value than they would have received if we did a straight cash-on-cash type of a deal. The community will benefit because we're going to be creating lots of jobs within this nucleus. We're going to be demonstrating net zero building elements across the board, and we're also going to be demonstrating what we're calling a human permaculture. And it's a term that we coined for lack of an ability to describe this otherwise. But the concept is that people want to live and work here. And if they want to live and work here, then that gives extra value to the entire project altogether. And every company had to be a public benefit corporation, and they're also going to have to sign up for what's equivalent of a homeowners association set of rules, which will include moral codes and ethical codes that we're talking about. So issues involving discrimination and equal pay and so forth, we're going to have those into the rules, and you have to abide by those to remain a resident in this project. And as a result of that, we're going to see a lot of social causes that are going to say, yeah, we want to showcase projects. So we've got a lot of people to talk to. When you're going out to do your capital campaign strategy, you want to do this analysis. You want to find out who's going to care about your success, why they're going to care, and even if they don't have the ability to write you a check, they'll have a motivation to introduce you to someone who may be able to write the check and can help you get the word out on your particular campaign. So what you're going to get in the documents, we're going to have a set of documents come out with tonight's program. With the slide deck, we'll put out some handouts, and then there'll be the guidebook, which is in development, so it's trailing a few weeks here, but I hope to accelerate that here this summer. And then within about 10 days, the video of tonight's program will also be posted, and you'll get a notice of that to all the members of the group. We'll be told that where it's at, and you'll get a download link, and you can pull this down for your own use. So there will be a capital sources analysis talking about this, giving you an explanation of who, why they care, where you might look, and what could help you figure out who you want to talk to. So that concludes part 2 of tonight's program.